4 stock markets have crashed? Don't panic, learn to profit from it. You want to invest and become wealthy, right? Great. But now your portfolio is all red. The numbers keep falling. The more you check, the worse it gets. The news screams about crashes, recessions, and crises. But what does it really mean? Should you panic and buy more? Or sell everything? Or just close the app and take a deep breath? Before doing anything, remember that many historical crashes created new millionaires. This could be your opportunity to get rich. So how can you do it? First, understand why the stock market crashes. Is it normal? Or should you really worry? How can you survive this period? And most importantly, why do some people profit while others lose everything? In this video, we will explore everything you need to know about market crashes. Let's get started. Part 1. Why the stock market crashes. To understand this, we first need to know the cause. A crash occurs when stock prices drop sharply in a short period, meaning many stocks fall at once. There are usually 3 main reasons: bubble bursts, economic weakness, and black swan events. Let's analyze each one. First, a bubble burst. You may have heard the term bubble in stock investing. But what does it really mean? A bubble happens when stock prices rise far above their true value, usually due to hype and crowd psychology, rather than real business growth. And when investors realize this, they start selling, causing prices to plummet. A real example is the dot-com bubble in the early 2000s. The internet was the new craze, and investors poured money into any company with .com in its name, even if the company had no profits or clear business model. At its peak, over 400 internet companies were listed, and the NASDAQ, which is tech-heavy, rose over 800. But when people realized most of these companies weren't actually making money, they sold off their stocks and the bubble burst. The NASDAQ fell nearly 80, wiping out trillions in market value. And it took 15 years to recover pre-bubble levels. That's how bubbles work. Hype inflates prices and reality bursts them. For a market crash is a weak economy and certain economic policies. When the economy deteriorates, for example, when inflation is too high, causing food and rent prices to soar, people cut back on spending, leading to lower business sales, and businesses make less profit. People cut back on spending. This causes businesses to sell fewer goods, and businesses make less profit. Investors expect future earnings to be weaker as well, so they sell stocks, driving prices even lower. If this continues, it can lead to a recession. When the entire economy contracts, production slows, spending declines, and investors panic, pushing the stock market even lower. That's why economic recessions often coincide with stock market crashes. Sometimes economic policies can also trigger a crisis. When inflation rises too high, central banks raise interest rates to control inflation. This makes borrowing more expensive. Businesses needing capital struggle. They are forced to cut production. People start saving and spending less. This spreads worry, and stock prices fall even further. That's why, every time the Fed announces a rate change, investors get nervous. If rates rise, borrowing costs for businesses go up, and stock prices usually fall. Conversely, when rates drop, borrowing becomes easier. Businesses get more capital to grow, and stocks generally rise. The third reason is black swan events. This term refers to unforeseen disasters like wars, pandemics, or terror attacks, financial scandals, and other shocks. Such shocks make people fear the future of the economy. They panic and sell stocks as fast as possible, causing sharp price drops. A real example is the COVID-19 crash in 2020. No one predicted the pandemic, and in just a few weeks, global markets fell over 30% as investors feared business closures and a global economic collapse. So the 3 main causes of stock market crashes are bubble bursts, weak economies, and unexpected events. Of course, other factors like financial leverage, margin calls, or herd mentality, but we won't go too deep into those. I want to keep this video simple and easy to understand. Now that we understand why stock markets crash, the real question is whether this is normal or something to worry about. Let's explore in the next part. Part 2, is it normal for stock markets to crash? The answer is yes, it's completely normal. Stock markets don't just go up forever. They operate in cycles with ups and downs. If you're a long-term investor, you need to understand that crashes are a natural part of the game. In fact, for traders, these fluctuations are opportunities to buy low and sell high. If stocks only went up, everyone would only invest long-term instead of trading short-term. As unbelievable as it sounds, history proves that. Because if stocks only kept rising, everyone would only invest long-term instead of trading short-term. As unbelievable as it sounds, history has proven that. Markets always repeat downturn cycles, following similar patterns. The first type is called a pullback, when stock prices drop about 5 to 10%. This happens almost every year and is considered normal market volatility. The second type is a correction, when stock prices fall 10 to 20%. As the name suggests, a correction occurs when investors realize stocks are overvalued and adjust back to a reasonable level. This usually happens every 1 to 2 years. The third type is a bear market, when stock prices drop about 20 to 40%. This usually occurs every 3 to 6 years, often due to an economic slowdown or rising interest rates. The economy is not always as perfect as a fairy tale. Finally, there is a crash, when stock prices drop more than 40%. Such crashes happen roughly once every 10 to 20 years, usually triggered by unexpected events like financial crises or global disasters. Here's a comparison chart of the different downturn phases. You can take a screenshot if you like. History has repeatedly proven that markets always recover, and often even stronger after each crash. In 1970, the oil crisis crash caused the market to drop nearly 50%, taking about 7 to 10 years to fully recover. On Black Monday, in 1907, the New York Stock Exchange fell 22% in a single day, but recovered within 2 years. During the 2008 financial crisis, the S&P 500 dropped nearly 50%, but recovered in 4 years. In the COVID-19 crash, in 2020, the ASX fell 30% in just 5 weeks, but fully recovered in only 4 months. Different crashes, but they all share the same pattern. Markets fall, then rebound stronger than before. So who loses money? Those who panic and sell. Who makes money? Those who stay calm and hold good stocks. However, some worry and say, past performance doesn't guarantee the future. What if this time the market crashes and never recovers? Then what? That's a valid question. But there are indicators to help you identify when a crash is just a natural cycle and when you really should worry. A crash is considered normal. If businesses are still operating, people are still spending and enjoying life, and the government has taken measures to stabilize the situation, in that case, the market usually recovers. However, this mostly applies to large and stable economies like smaller or less stable countries. The recovery process may take longer, so you need to understand your country's situation. You should only worry if the entire economy starts collapsing. For example, if many businesses go bankrupt, banks fail, people can't withdraw money, and the government declares national default. Such situations are extremely rare, but if they occur, they are very hard to recover from. Now you understand when a market crash is normal and when it is not. The next question is, how to survive during a stock market crash. Let's explore in the next part. Part 3, how to profit. When the stock market crashes, it sounds crazy, but these periods can be the best time to invest. You may ask, how to survive such a crisis? But surprisingly, many people actually made huge profits during crash periods. For smart investors, a market crash is a great opportunity to build long-term wealth. As Warren Buffett once said, be greedy when others are fearful. So how do you actually do that? Let's go over common mistakes and the right approach so you can profit, even during a crisis. The first mistake is panic selling. When you see your portfolio all in red, many people's first instinct is to sell everything to avoid further losses. But the truth is, you haven't really lost money until you sell. Stocks may be falling, but they still have a chance to recover. If you sell at a loss, that loss becomes real. If you invest in strong companies with stable profits, there's usually no reason to sell just because the market is falling. Instead of panicking, stay calm, stay informed, and focus on your long-term goals. The second mistake is trying to time the bottom. Some investors try to predict the lowest point of a crash and wait for the perfect moment to buy. But the problem is, can you really predict the exact bottom? Many wait too long and miss the opportunity, while others buy too early, thinking prices won't fall further, only to see them drop even more. Instead of guessing, a better strategy is dollar-cost averaging. This means investing a fixed amount regularly. So, when prices fall, you buy more. And when prices rise, you buy less. This way, you don't have to worry about timing the market. And as long as you buy strong companies with good profits, it is a safe and effective strategy for the long term. The third mistake is buying weak stocks just because they're cheap. Notice how I always emphasize buying strong companies with good profits. Why? Because when stock prices crash, many are tempted to buy anything that looks like a bargain. But not every company recovers. Some businesses go bankrupt completely, and their stocks never bounce back. That's why you need to focus on companies that are strong, highly profitable, with low debt and stable revenue, a history of weathering tough times, and long-term growth prospects. When the market crashes, good companies usually become cheap, not because they're weak, but because people panic. For example, before the 2008 financial crisis, was trading around $90 per share. If you had $1,000, you could buy only 11 shares. When the market crashed, Amazon's price fell below 40. With the same $1,000, you could buy 25 shares. If you had researched and believed Amazon was a strong company with good profits and high growth potential, that was a perfect time to buy. Just a few years later, Amazon recovered and soared, reaching over $3,000 per share. That's an increase of over 8 times, meaning the 25 shares you bought during the crash would be worth over 75. The fourth mistake is not diversifying your portfolio. Some investors put all their money into a single stock in 20. That's an increase of over 8,000. This means the 25 share you bought during the crash would be worth over $75. The fourth mistake is not diversifying your portfolio. Some investors put all their money into a single stock or a single sector, thinking it's a sure bet. But when a crisis hits, some sectors drop more than others. Smart investors usually spread their money across multiple fields, such as technology, healthcare, consumer goods, and utilities. So if one sector falls sharply, others can offset the losses. Some even diversify into other asset classes, beyond stocks, like bonds, commodities, or international stocks, to reduce risk when the stock market dives. If picking individual stocks seems too hard, you can consider buying ETFs or index funds. These tools automatically allocate your money across multiple stocks, so you don't have to select each company yourself. The last mistake is FOMO, fear of missing out. When panic spreads, people blindly follow the crowd. If everyone sells, they sell. If the news says it's the end of the world, they believe it. But even legendary investors, like Benjamin Graham or Peter Lynch, have said that even Wall Street experts cannot predict the market with absolute accuracy. So make sure you understand what you are buying through your own research. And if you're still unsure, you can consult a financial advisor. No matter what, you must always understand your investments. Never follow others blindly, even experts. As Warren Buffett said, never invest in something you don't understand. These are common mistakes and smart actions for beginners. However, there's another strategy professional investors sometimes use to profit during a crisis. There is another strategy that professional investors sometimes use to profit during a crisis, called short selling. This means betting that a stock's price will fall. For example, imagine your friend owns a stock worth 100. You borrow the stock, sell it immediately for $100 and wait. If the price drops to $70, you buy it back, return it to your friend, and keep the $30 difference. But if the price goes up instead, for example, to $120, you'll have to buy it back at a higher price and take a loss. Some legendary investors have made billions from short selling the market, but the risks are extremely high. So I'm only explaining the concept for your understanding, not encouraging you to try it, especially if you don't fully understand how it works. In summary, a stock market crash can be frightening, but it's actually a natural part of the cycle. Throughout history, the U.S. stock market has always recovered and even reached new highs after each crash. No one can predict the future exactly, but past patterns show recovery is highly likely unless the economy collapses completely. The key to surviving and profiting during a crisis is to stay calm, avoid panic selling, research thoroughly, and buy quality stocks when they are discounted. Those who sell in fear lose, while smart investors turn crashes into their greatest opportunities. So when the next crash happens, don't be afraid. Be prepared. If you want me to make more videos explaining topics like this in depth, please like and subscribe to Knowledge Station. Thank you for watching.